These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, that end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation we will enter an adjusting entry for accrued interest into our bookkeeping problem in Excel, keeping in mind how that same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're first going to take a quick look at QuickBooks and then move on to Excel and enter the data there. What we will be doing is entering accrued interest related to the loan. You'll recall we had two loans before this. One was a $5,000 and one was a larger loan. We're accruing the interest expense on the $5,000 loan, and we're saying that the payment of the $25 interest, which will not be paid until the end of the loan, has accrued, meaning we have incurred it. We've been using the $5,000 loan for a month and therefore owe the interest at the end of this time period and need to record the expense and related liability for that. I know this is a small amount, but this will give us the principle of the concept. Within QuickBooks, we typically would do this with a journal entry with just about any accounting system needing to know debits and credits, but it is possible within a QuickBooks system to use registers in order to do this. And that's one way we can take a look at this and go through the interest payable register and enter the data in that format. We're going to work this in Excel and work this through the entering of a journal entry. Here we are in Excel. We're going to have a new journal entry. We are on the Adjusting Entries tab. This is going to be the worksheet where we're going to enter the data for the adjusting entries here in terms of the journal entry. And then we're going to post that not to the general ledger, but to the adjusting column, giving us a quick view of the unadjusted trial balance and the adjustments that we will be doing all as of the end of the time period. We're going to go back over here and put the date of 2/28. This is going to be a more traditional adjusting entry. Most adjusting entries, unlike the one we did before, which was really just a reallocation of the short-term and long-term, will have a balance sheet portion and an income statement portion, meaning there's going to be one account above the blue line, which is going to be an asset or liability account, and an account below it, which will be a revenue or expense account. In this case, we're dealing with interest, so there's going to be an account above the line related to interest, and it's going to be interest payable. So I'm going to put a little yellow mark right here. I'm just going to right click in E13 and put a little yellow mark. We're going to be dealing with that account right there. And then scroll down and we're going to have another account below the line in the dark blue dealing with interest. That's going to be interest expense. So we'll have interest expense here. Going to right click there and put a little yellow mark there as well. We also know that interest expense, like all expenses, have debit balances, and we need it to go up. So we're going to do the same thing to it, which in this case is a debit. So without even knowing what we're doing, and we will talk about what we're doing, we can get a lot of the accounts and which way they are going just going through this process, meaning most of these accounts are going to have some account above the line here in terms of equity, and most of these journal entries that are adjusting journal entries will have an account below the equity account, and they'll all be named somewhat similar to what we're doing here. This is related to interest, and therefore we're dealing with interest expense, and expenses only go one way. Like all income statement accounts, they only go up. Therefore, we know that we will be debiting the interest expense. So I'm going to copy that and put that up top. We'll put that right here. That's going to be the account we will be debiting in this process. Right click and paste 1, 2, 3. And if we debit that account and the other account related is this one, and there's only two involved, this must be the credit and therefore go on the bottom. So we're going to copy the interest payable by right-clicking on it, copying it, and putting that in B10, right-clicking, and paste 1, 2, 3. I'm going to go ahead and indent this by going to the Home tab, go into the Alignment group, and increase the indentation. And then we just need to know the amount here. So once again, we put that together with not knowing too much more than just the fact that we're going to be dealing with interest, and it's an adjusting entry, and therefore we have interest expense and interest payable. Also note that these adjusting entries almost never deal with cash. These are going to be timing differences. Cash has been taken care of in the normal accounting process and when we reconcile the bank account. So cash pretty much is what it is at this point, and we're just doing the other types of adjustments. So if we scroll back over here to our amortization schedule for the $5,000 loan, what we're saying is this first amount here, this payment, it's actually, we're not making payments until the end of the loan, but we have 6 periods, 6 months, and that means that the interest is accruing. We do incur interest, just like if we were to rent something, we still incur the rent that we are using the place, even if we haven't yet made the payment. Same concept here. We haven't yet made the payment, therefore haven't recorded the interest expense yet, but a month has passed, and therefore we should recognize the fact that we owe $25 more than we originally had on the $5,000 loan, and therefore that's what we are doing here. We're going to increase the interest expense, the interest that has been incurred over the use of this money, and increase the payable, not the loan payable. We're going to make another account called interest payable, and it'll be another liability account related to the loan, but we're going to track that separately. So we're going to scroll back over to the left and record that 25. It's going to be $25 interest expense. We're going to have the same amount on the credit side. We have now journalized the adjusting journal entry, and we will now post it not to the general ledger, but to our worksheet. So we're going to record that in the middle item of our worksheet, giving us a nice quick check as to what is going on. Again, worksheet ideal for just a few journal entries. It's really great for just a few journal entries because it gives us a quick look at the big picture and seeing everything that is happening. So we've got the interest expense here. It's going to be in order: assets, and then liabilities, and then equity, and then income and expenses. We're down here, interest expense. We're in cell M27. M27, this is where we will post the journal entry. What we're going to do is say equals, and then scroll up just a bit and point to that $25 debit. Let's do that now. We are in M27, selecting equals. We are scrolling up just a bit, and we are pointing to that $25 and enter. The amount now goes from 0 up by 25 to 25. We are out of balance now by the 25 till we record the other side, and we see that that has decreased the net income. Remember, net income is revenue minus expenses, and this revenue accounts, these revenue accounts, are credit balance accounts, expenses debit balance accounts. Therefore, this bracketed number is revenue or net income over the expenses, revenue over expenses or net income. It was at $6,847, went down by the 25 to the $6,822. Let's now record the other side. Other side is going to go to the interest payable account. Here's the interest payable account in the liabilities section. It's going to be increasing because we are crediting it and they are credit balance accounts. We're over here in M13, so we are in cell M13, selecting equals and pointing to that $25, bringing the balance up from 0 to 25 in the credit direction. If we scroll back down and see what that we are indeed back in balance. As we're working with this, we can note how easy it is for us to just check what is going on in terms of the accounting equation or any individual accounts with the worksheet. So note that obviously within the liabilities, all we have to do is highlight the liabilities in the unadjusted trial balance. That's $78,832, and see what happened to the liabilities by highlighting them afterwards. And we still have the we have $78,880. We have $78,857. The only real change being that 25, because this is just a transfer from one liability to the other. We can see the effect on the total equity. Remember, the net income is everything from here down to here. Total equity, if we just highlight the draws all the way down, that's going to be total equity. It ends at $150,802. It started at $150,827. We can also calculate that by saying assets minus liabilities, which are debits of assets, minus liabilities gives us the equity, and that's the $50,827 starting point, and we ended at assets minus liabilities. 50,802 ending point. So we can get most of what we need just from this nice little worksheet. It's going to be a great tool to have as we go through the adjusting process, and it's typically what is used during the adjusting process. Hello, in this presentation we will record an adjusting entry for accrued interest within QuickBooks Pro 2018. If you've been continuing along with us, we will be continuing with Get Great Guitars problem. If not, that is okay. We will be doing an adjusting entry for accrued interest and show how to record that adjusting entry both with a journal entry, but then we're actually going to do it without the need for debits and credits. We currently, if you have the backup file, you could restore the backup file by going to File, Open and Restore, bringing us to this point in time so that we can record the accrued interest. If not, then you can work through the problem and or watch what we're doing here and follow along for this example. We have the current windows open. In order to open the current windows, go to View, Open Windows List. We also have the Home tab open, that found at the Company, drop down, and the Home tab. What we will be doing is recording the accrued interest. In order to do that, we're going to first look at the balance sheet to see what accrued interest is and why it would need to be recorded. To do that, let's go to the Reports drop down up top. We're going to go to Company and Financial and then scroll down to the Balance Sheet Standard. We're going to change the dates by going to the Customize Report up at the top. And we're going to change that date to 01/01/21, January 1st, 2021, to 02/28/21, February 28th being the month end we will be looking at. We're going to say, okay, here is our balance sheet. Now, last time we saw that we had a loan payable on the books with a current portion of $18,109 and a long-term portion of $56,769. What we need to do now is figure out how much of that has been interest, how much interest has accrued on these loans that have not yet been paid as of the end of the month. This is a type of journal entry that we would do if presenting the financial statements and or wanting to interpret the financial statements at a specific point in time. Not something that we're going to do as we go typically. We're not typically going to record the adjustment for the amount of interest owed because we'd have to do that daily. So this is one of those adjusting entries we'd have to do at the end of the month or the end of the year in order to get a real picture of what we owe at that point in time. So in order to get an idea of that, we're going to look at the amortization tables related to these loans. Here is the amortization table. We have a long-term loan over here, and we have a short-term loan. Now the long-term loan, we made the second payment as of the end of the month. We are in essence paid up on that loan, meaning no interest has accrued because we made that second payment as of the end of the time period. So we're okay there. We're going to go to the short-term loan, and on the short-term loan, we're going to pay all of it at the end of the loan payment. So we're going to owe $5,152 at the end after borrowing $5,000, it then having interest at 6%, which will accumulate up to that $5,152. And we took the loan out. This loan, we recorded it actually at the end of the month, but we're going to say that this loan was as of the beginning of the month, and therefore we're going to have 1 month worth of payments that we have not yet paid, to give an example of the accrued interest, meaning after 1 month we're going to owe interest of $25. Now, obviously, this loan is not a large amount of a loan, so the 25 may seem not significant, and it may be not significant here. But the principal would be significant if the loan was larger, and or when we get to a year's worth of interest, if we haven't accrued it, this could be a significant portion. So what we're going to say here is that we owe this payment, or we owe the $5,152 at the end of the time period, and this interest is accruing as we go. And we're going to assume here that 1 month has happened, and we then have earned rent on the money, $25, that has not yet been paid, and therefore we are going to have to accrue this $25, meaning we're going to have a payable for it, and we're going to recognize the interest expense for it. So in essence, we're going to have interest expense increasing, and we're going to have a liability increasing. So if we go back to our financials, then we have a long-term payable, note payable, and we have the short-term portion of the note payable. What we want to do is not put that added interest into the note payable, but create another account, and we're going to call it, it could be called accrued interest. We're going to call it interest payable, however. We're just going to call it interest payable, and we're going to have that in the current portion of our liability, our current liabilities portion of our balance sheet, representing the fact that we owe interest on the loan that has been outstanding up till this point. So in order to do that, we could do that by going to the company and going to the make journal entries, company, make journal entries, and then debiting the account for interest expense and crediting the account for interest payable. But we're going to do this without debits and credits. So what we're going to do, we are going to use a register. So the registers are going to be in the banking section, and then we go to register here, and we're going to look for a register. We're going to look for one of those two accounts that we're going to be using. It's going to be interest payable and interest expense, and we're going to use the register for one of those accounts and then use that to increase or decrease and then apply the other side to the other account. There is a problem, however, in that we only have registers in QuickBooks for permanent accounts or balance sheet accounts, and therefore we haven't yet set up the payable account for interest payable, and the other side's an expense which doesn't have a register. So in order to use this method, we first need to create an account for the interest payable. To do that, we're going to go to Lists. We're going to go to Chart of Accounts. And then at the bottom, we're going to go to Account. And we're going to create a new account. It's going to be an Other Current Liability. So we're going to select Other Current Liability over here. Other Current Liability. And we will then continue. And we're going to name it Interest Payable. So it's interest payable. That's all we're going to need within this data field. So we'll say save and close. And then we can go back to our banking, use register. And it's open there directly because I was on the interest payable account. So if I'm going to close this out and close this out, and once that's closed, if I go back to banking, use register, then I'd have to find that in the drop down. So just note that sometimes when you go to this register, if you have certain fields open, it will go to the register where the field is open. And if you want to go somewhere else, you'll have to close that field. So we're gonna select the account. So we'll select the drop down, and we're looking for interest payable, the account we just set up. So this is the ledger account for interest payable when we select OK. And now that we have this, we can say we're going to increase or decrease this account, and then the other side will just be the other side. It's still a little bit confusing because we need to know interest payable is a liability account and the liability is going up. So the liability is going up because we're accruing interest. So we're going to say it's as of the end of the month, 2/28, and we're going to increase the interest payable by the amount of interest in accordance with the table, which we're saying is $25. I just switched to the amortization table here. And then going back to QuickBooks, increase of $25. And the other account then is going to be interest expense. So we could select the drop down, or we can just type in interest expense. It's going to be an expense type account, and that will be the other side of this. And then we need to select enter for it to be entered. And we might want to put adjusting or ADJ entry and to accrued interest and enter for the note. And then we can go back to our balance sheet, and if we scroll back down, then we should have our interest payable account here on the balance sheet showing a liability for that interest that is due for the fact that we've earned money or we've been using money for which we have not yet paid and therefore owe the rent or interest on it. There's the amount, there's the adjustment. If we close this back out and we then look at the other side, it's going to be on the income statement, go into the reports, go into company and financial and profit and loss, changing the dates to 01/01 21 to 02/28/21. Scrolling down, there's our interest expense here. If we double click on that, we see the 25. Double clicking on that, there's our item. So there's the accrued interest expense. This journal entry will reduce net income and will increase the liability. What we're going to do next time is we're actually going to reverse this entry as of the first day of the next month. And this is only going to happen for some of the adjusting journal entries, not all of them. And the reason we're going to do this for some entries is process reasoning, meaning if we're doing the adjusting entries as of the end of the month and we have that separate process than the data entry, which is often done by a whole different department, then often it's easier for us to do some of the data entry on more of a cash basis or more of a different system than to have to deal with our adjusting entries. In other words, if we go back to the balance sheet here, when the actual payment actually happens for interest expense, we would like it to be easy for the person actually writing the check at the end of the 6-month period to just say, I'm going to write a check crediting cash or decreasing cash for $5,152 and writing off the interest in accordance with this amortization table of 152, and then putting the other side to decrease the loan payable. What we don't want them to have to do is deal with our reversing entry. So what we're going to do is reverse our reversing entry as of the first day of the next time period, and therefore when this becomes due, they can just go according to the amortization table and not be confused with this interest payable that we put on the books. What that does, if we go back to QuickBooks, is it makes this correct as of the end of the month, and then it's not exactly going to be correct once we do the adjusting entry in January 1st, but it will then be correct once we make this payment, once this payment happens. So we're gonna keep on adjusting our adjusting entries to make everything correct as of the end of the month, and then we're gonna try to make it as easy as possible for the bookkeeper not have to deal with reversing our adjusting entry in their normal bookkeeping process. And we'll see that as we go with a couple of these journal entries. Some of them will have that reversing entry, some of them will not. And our goal is to set up a system. So you want to think about a system that you can set up that will be workful and it'll do what you want it to do. It'll give us the information we want. It'll give us the regulatory needs we have to in order to report the financial statements. And it won't mess up our normal accounting process as we do the normal day-to-day journal entries.